Hey, listeners. Welcome to It's the People, our interview series where we explore the underbelly of building companies and investment portfolios with high octane founders, limited partners, and fund managers. We hope these conversations push you to be even better at what you do. This week, my partner Andy Greenfield and I had the opportunity to interview a good friend and extremely seasoned investor, where we discussed a range of topics, including the importance of people when you're partnering for the long term, the cyclicality of the venture capital industry, and the intricacies of the fund management business. Our guest, Brian Horey, is the president of Aurelian Management and starts out with a quick overview of his career. Before we begin, I want to note that this interview is for informational purposes only, and that the opinions expressed should not be relied upon as a basis for investment decisions. TI Ventures is a seed stage fund focusing primarily on early stage B2B technology companies, with an obsessive focus on end customers and early teams. Hi, everyone. My name is Wills Hapworth. I am super excited to announce that Brian Horey is our guest today. He is a seasoned investor, as well as working with early stage companies in a variety of capacities, and also has been involved in the venture capital world for decades now. And Brian, I probably am not doing full justice to your background, but maybe you could paint a quick picture of yourself as an investor across asset categories and where you focus.
Sure. So I've been involved in investing money on the principal side, I guess, for about 35 years. I started my career on the sell side as an investment banker for a few years, went to business school. Coming out of business school, was in the venture capital business for a dozen years, and since then have been managing a portfolio of public equities, as well as doing some private investing directly in some early stage companies, as well as in funds, primarily venture funds.
And, I guess broadly speaking, what's been your experience so far investing across stages of whether it's early stage venture capital, growth equity, all the way up to public equities and public markets?
Well, I think each has their own risk and reward profile. Some are more cyclical than others. The venture asset class is the most cyclical. It's kind of at the far end of the curve in terms of historically, at least, in terms of availability of capital, and whether the market is in an oversupplied or undersupplied state, as well as the kind of returns that tend to accrue depending on where you invest in the cycle and what kind of trends there are from a technology or economic dynamism perspective to invest in. The public markets are kind of a different animal. You have, depending on your size and the assets that you're investing in, you can have almost instant liquidity or liquidity that's on a very short time horizon. You tend not to have the information advantage that you do in private markets, although I think there's still inefficiencies, and also I think the other big difference in the public markets in the last 10 to 20 years is the growing pervasiveness of passive strategies over active strategies, and the dominance and the impact of those strategies on the performance of equities.
It's a complicated landscape. How do you decide where you want to play, whether it's early stage versus later stage, or maybe it's a piece of all of it? Like, how do you choose where you allocate your time, capital, energy, research?
Yeah, I think that at least historically there's been a pretty cyclical nature to the venture business, and particularly at the later stages, I think the later stages of the cycle. I think late stage, venture tends to have pretty unattractive risk reward characteristics because you're being priced basically at a discount to the public market, and you also have you tend to see a lot of entry from non-traditional players, either public market investors, corporate venture funds, who tend not to be either as price sensitive or as sophisticated. I mean, some of that can be dealt with terms and structure, but I do think that the risk rewards in that segment tend to get a little skewed as you get towards the towards the peak of the cycle. And if you invest at the wrong time, you still have a lot of the same illiquidity issues, although that's changed a little bit, obviously in the last 10 years or so with the development of a secondary market for private venture equities.
Brian, should we interpret that as you work your way through the alphabet of funding stages, your appetite as an investor decreases, or is that the wrong way to interpret it?
Well, I mean, my situation is probably, also a little bit different. I mean, the scale of the venture business has increased so much that, the later stage funds, in terms of the scale of money that they're investing, probably aren't looking. I mean, I'm typically investing out of my own pocket, and they're probably looking for, for much bigger commitments than I would do, unless it was, kind of, if they had a friends and family allocation, something like that. Whereas, an early stage fund like yours is something that makes more sense from a size perspective. But I do think you really have to be cognizant of where you are in the capital market cycle, particularly for the venture asset class. I mean, I think that also applies to private equity buyouts as well, given the prices that people are paying, as well as those deals to work depend on a robust leverage loan and junk bond market. And if you make a commitment to a deal on the assumption that those markets are going to be there to provide the bulk of the capital, and that turns out not to be the case, and the economics of your deal are going to get screwed up pretty quickly. I mean, the other thing I think that's evolved with a lot of those deals is that there's a pretty typical behavior of those funds doing dividend recaps. Depends on how the deal goes, but they might do it as soon as 6 or 9 months after a deal closes, but maybe 1, 2, 3 years out. And so again, that extraction of capital and kind of removal of basis really depends on those two debt markets being receptive to what you're trying to sell them.
You talk a lot about cyclicality in venture. And I'm curious, as you look at this current market, do you think it's the same old, or is there something different right now that we're looking at in terms of cyclicality in venture?
So I'd say there are probably two things that are a little bit different this time around. I mean, I think generally speaking, there's a lot of capital being deployed in the business, in the asset class, and pricing looks, generally speaking, quite rich to me. I think maybe the two things that are somewhat different this time around is that you've got this really unprecedented involvement of the Fed in the capital markets, and they have removed basically any short-term, real interest earning capability, or even long-term and in a real sense, from the market. So what they've done is that they've had to push people out on both the duration curve and on the risk curve to find returns. And so I think that has moved, on the margin, some significant amount of equity or of capital into the venture business. And as we've seen in the last 15 months or so, historically, when the Fed was not as involved in the markets, and you had an event like COVID or some other kind of economic contraction, you'd see frequently either a seizing up of the capital markets or a real constraint on the amount of liquidity that's available, and that inevitably filtered through to the venture market and the private equity market. And this time around, the Fed came with everything it had in terms of liquidity, and also devised new ways to put cash into not only the capital markets but into consumers' pockets, and really mitigated both the economic downdraft and the impact on spending, as well as what happened in the capital markets. And if you talk to people in the distressed debt market, they'll tell you that basically there was about a 2-week cycle in the second half of March last year, and by the end of that time, the Fed was so prevalent in the markets that a lot of the really rich opportunities went away, or probably maybe 6 weeks, but by the end of April, the corporate bond market had basically come back in a very big way, and even some very distressed retailers like Macy's and people like that were able to raise money in the junk bond market, when in most other economic contractions like that, somebody like that would have probably gone bankrupt. So that's kind of a long-winded way of saying that the Fed's presence in the market, I think, has mitigated some of the cyclicality that we've typically seen in the capital markets. And so I think that's been a benefit to the venture asset class as a whole, just because it's kind of at the whip, it's at the end of the tail in terms of both the duration of the asset and typically the volatility of money flows into it. The other thing I would say is that we live in a world that's really starved for growth, I think, is kind of a general statement. And so I think that has really benefited businesses that can grow at high rates over sustained periods of time. And so I think that has really helped the venture asset class. The other thing I think that's helped is just from a technology dynamic, is the proliferation of connectivity amongst people around the globe as a result of data networks and things like mobile devices, where everybody's connected and potentially is a consumer or a customer of a lot of different businesses and services, and where you've seen those the businesses that work like a Facebook or a Square or somebody like that, can scale to levels that people really couldn't dream of before in relatively short periods of time, kind of 5 years or so. You can have a global business. Airbnb would be another example, or Uber, where you can have a global business that either completely dominates a niche or has obliterated its incumbent competition, and those kinds of things really just didn't happen 20 or 30 years ago. And I think the infrastructure that is there now allows businesses that figure out how to unlock that that value and that access to grow quite rapidly. So even though valuations are high, you've also got some outcomes in terms of these hyper growth companies that in some cases at least can justify those valuations.
It's always intimidating when we get to talk and I hear about I guess the high level of thinking that's going on in your mind and all the gears that are turning around kind of macro market dynamics. Because I compare it to what Andy and I do, where we're talking with the Airbnbs before they were ever Airbnb. Nobody knew who they were or cared who they were. And yet they became, a company that is a household name now. And so as you start to look at allocating capital to the earlier stages of the funding ecosystem, where there's less objective criteria to measure these companies against and managers against, how do you How do you apply the same rigor that you look at kind of the investment landscape across to the earlier stages of kind of the funding ecosystem, where some might argue it's a bit more art and a bit less science?
Yeah, I think that's true. And I think at that stage of of investment or business maturity, I think a lot of it really comes down to a bet on the people involved, and typically the founder and the entrepreneur. Um, because it's very hard when Airbnb started with a guy with a couple of air mattresses on his floor, right, renting them out to people that were in town for a conference. And so to kind of go from that to say, okay, this is a business that's going to potentially be a threat to Marriott in 5 or 10 years, is a huge leap, right? And it's I mean, if you want to talk about it, it's very hard to model that. It's hard to put probabilities on that. There's so many variables and so many things that compound in that. So I think it's really a question of does this person seem to have both the character traits that are typical of successful entrepreneurs? Do they have a perspective on the market or on a particular application that other people really haven't conjured up before? And is the power of that vision and kind of the supporting technology or other market developments that are they kind of all lining up more or less at the same time, or what things have to go right in order for this business really to have to to click? And so obviously there's a bunch of kind of compound probabilities in that makes it hard to know for any one business how that's going to line up, but you've got to make a lot of subjective judgment calls about those kind of things. And I think that's where experience and some of your heuristic judgments really start to become a lot more important, because it's impossible to put to judge those things with any degree of precision. But if you've seen enough kind of business movies, at some point there are some patterns that start to recur, and you start to recognize some of them and either see the risks or see how things can play out if things go right based on what on some analogs that are never going to be perfect, but at least can fire off some signals for you that say this kind of looks like this, and if these things happen, this you might get this result.
Go for it, Andy.
Brian, that's super helpful. I'm curious, as you think about the idea of investing in early stage, a lot of LPs are high net worth folks or family offices, often involved in the early stage world. And a lot of them are always talking about going direct. I'd love to hear your perspective on going direct versus going through an early stage manager, kind of pros and cons, and where you come out on that.
So I think there are, there are a couple of things that, I think my belief is that you can only do so many deals kind of at once if you're really going to give them the amount of support that they need. So I think you have to decide as a individual investor, how much time do you have to allocate, and can you really support the team in a way that that it deserves, and are you doing enough to kind of have the right set of relationships that can really help them to the degree they need that help. And so I think it's kind of it's a bit of a make versus buy, as well as I think there's some scale economies in terms of relationships and solving more or less the same problem across a group of different companies. And again, those problems are never going to be exactly the same, but there are some themes and some commonalities, and they're probably sources of expertise that you can draw on, or in a fund, you're going to see you're going to see those things happen multiple times in the course of, certainly the life of a fund, but even within a calendar year, you're going to have multiple companies kind of dealing with the same issues in various forms. And so, there are things you can learn from one situation and apply to the next, or say, hey, Joe or Jane at XYZ company solved this problem, last year. Why don't you go talk to them about how they worked their way through it, and what were the solutions they considered, why was this piece of software better than another one, those kinds of things. And ultimately every company has to make its own decision, but you can help them get up the curve quicker if you can put them in touch with somebody who's already done that. So I think a fund is going to have, all of the things being equal, have access to more resources. But as an individual, you may have particular expertise in a market that's relevant to the business, or you may have a particular chemistry with a founder, either from some prior relationship, or just, you just hit it off well. And so I think in those situations, you can bring value, but I think you have to be honest with yourself about, do I really have the time to commit to it? And is there somebody better suited than me to actually help these guys out?
Speaking of somebody better suited, we all the time we run into the phenomenon of the brand name venture capital funds. And one topic we hear discussed fairly often is the benefits of brand name versus an emerging manager. And I'm curious about your view, brand name versus the emerging manager. Any feeling one way or the other? Is one just a safer bet that's easier to explain? Any point of view there?
Well, I think it depends. I think it depends on maybe who you are and where you sit. I mean, if you're a member of an investment committee in some kind of an institutional setting, it's like the old saying, you never get fired for buying IBM. So in those situations, I think there's a lot of institutional biases and pressure, to buy the brand name. And even if they have a bad fund, you're probably not going to get fired for doing that. On the other hand, if you invest in a first-time fund, and the two or three people running it end up getting at each other's throats, and they make a bunch of investments, the thing blows up. Two of them walk away. One's left to try to salvage what's left of the investments, and you end up getting a subpar return from that. Well, then you're probably I don't know if you get fired, but it certainly doesn't it certainly isn't going to be a career enhancing event for you. So on the other hand, if you're an individual and you're willing to take some risk and realize that not every single thing is going to work out, but in the aggregate, if you make enough right calls, you're going to come out all right. And maybe if you find and really has a distinctive perspective and a distinctive deal source, and is really whose interests are well aligned with yours, and really has the incentive to go out and kind of establish themselves as an effective manager. In many cases, you can have above average returns with those managers. I mean, the other thing is that, the other reality, I think, of the fund management business is, at a certain point, it's about assets under management and not the returns. In terms of, if you look at the economics for the general partners, if they amass enough capital, the fees that they earn on that are of a magnitude that, at least from their perspective, the returns on the fund are almost irrelevant as long as they're good enough to get the next fund raised. So whereas, for a smaller fund, the fees are going to pay they're going to pay your overhead and expenses, and they'll put some money in your pocket to put food on the table, but they're not going to make you rich. And what's going to create wealth for the manager in that situation is the carry. So I think, that to me is a more interesting alignment of of incentives between the GP and the LPs. And also, you do have I think a greater probability of outsized returns. There's probably also a greater probability of returns being, subpar as well. So there's kind of the distribution curve is going to have fatter tails. But I think if you invest in enough of them, that those will even out over time. And to some extent, they're different markets. I mean, the KKRs and the Sequoias and those people of the world, their customer base for the most part are, big state pension funds, college endowments, corporate pension funds to the extent they still exist, sovereign wealth funds. It's a different class of investor and customer, and they're as much worried about capacity as they are returns. I mean, those people have to put a lot of money to work, and another 100 or 200 basis points at the end of the day is nice, but what they really care about is, can they put $1 billion or $500 million into something, as opposed to whether it's going to be a 13% IRR or 15% IRR.
Brian, you started to paint a bit of a picture of what can go horribly wrong, and also talked a bit about alignment. Are there any, like, you have a great radar, are there things in particular that you look for in managers when you're evaluating, potentially partnering with them?
Well, I think you want to, have they worked together before? I mean, particularly if it's a fund that's, on its first or second portfolio, I think that's a big deal, because they've, if they have, then they kind of know each other's quirks and foibles, and probably have figured out how to get along, and how to, who's good at what, and just how to work together. So I think that's that's a big deal. And just kind of watching personal chemistry and interaction between people, particularly if it's a small group, I think can tell you things, as well as, doing reference checks with people that have worked with them in the past will give you some notion of what their personality and work style is like, and how they've dealt with adversity in the past. Because, if you're managing particularly an early stage portfolio of companies, you're going to have to deal with adversity. Things are going to go wrong. People are going to have to pitch in and figure out how to try to right the ship on certain deals, or when to walk away. So I think all of those things are important. And again, I think if you do enough homework, I think you can have it. It's never perfect, but you can have a pretty good idea of who's likely to get along and see their way through things. I guess the other thing is kind of, what are the economic incentives or the economic importance of the fund similar for all of the principals, or, is it easy for somebody to walk away if, after 2 or 3 years, the thing isn't working out very well, and they just, they decide they want to go off and do something else. Is that an option for them versus, some of the other folks that are involved?
And if you take the people out of it, anything that you look for in particular around a strategy, or that is a red flag, maybe around kind of the strategy of the fund?
Yeah, so I think you want to try to find fit between the strategy and the skills and experience of the people, and have they been involved in similar businesses, or have their experiences do their experiences in the past make them well suited to the strategy? Is what they're proposing to do a complete left turn from what they've done in the past? Particularly, I think if it's if the strategy of the fund is kind of the flavor of the month, I mean, I don't know. Last fall, if somebody came along and said, we're going to have a fund to invest in EV, companies and technologies, and the person had spent their career in biotech, or some other thing that kind of really had no relationship to that. I mean, that kind of a thing would be, I think, an immediate red flag, and somebody that's just chasing a stream of money versus really having knowledge, expertise, and network that that lines up with the kinds of things that they're proposing to invest in, as well as the stage of investing matters a lot too, because at the early stage you're really focused on company building and trying to find product market fit and hiring the first members of the team, versus a very late stage company. It's about how are you positioning to go public, and at that point you probably have some competitors, and trying to understand the competitive dynamics, as well as what have been the response of incumbents, and how are they going to affect the trajectory of the business. So they're much different problems and skill sets really that you need at those stages, different stages.
Has anything caught your attention recently that's come across your radar in terms of a fund that sounds like, wow, that's different, that's relevant, that's interesting?
Not really. I mean, I've not actually been out actively looking for new funds. I mean, I've got I kind of have my hands full with I've got 3 different private company projects that I'm working on, as well as managing my my public company investments. And so I kind of have my plate full at the moment, as well as some nonprofit stuff that I do. So I haven't really spent a lot of time looking at private funds of late, unfortunately.
If we now move from evaluating a manager to actually working with a manager, you've partnered, particularly early stage ones where, again, it's maybe a bit more art than science when they're just getting involved with businesses. How do you know if they're doing a good job? Because the gestation periods of these funds can be, 7-10 years. And in the early stages, how do you know if things are trending, in a good way?
Yeah. And that's tricky. I mean, I think, there's as you guys know, and I think probably a lot of the people that will listen to this know, there's something called the J curve in venture capital, where the losers show up early and hurt your returns, and the winners take generally a long time to mature, and you don't really see the benefits of that from a return perspective until the later years. And it's not infrequent that a company may bump along for 2 or 3 years and then finally figure out the product market fit, and all of a sudden and some other things may happen in the context of the investment that all of a sudden unlock and that opportunity, and the company may become extraordinarily valuable in its later years. So it is hard to judge in the first few years. I mean, I think the things you can look at are what is the quality of the entrepreneurs that the fund is partnering with. Are the companies able to attract follow-on capital, and who are the partners, the funding partners that are attracted in those or added in those follow-on rounds of funding. What seem to be the quality of the business ideas, and how are those playing out? And again, not all of them are going to work, and the losers are going to turn up early, but are they ideas that that seem like they're well thought out and have credibility, or is it a wag or something like that, where you kind of look at it and say, how's this really going to make sense? So I think those are, again, they're pretty subjective in the early going, but those would be some of the things that I would look at.
Got it. And you mentioned earlier, kind of, new access to capital, what I consider almost like a democratization of access to capital. And the job of a manager isn't just to pick the right companies, but then to kind of manage this portfolio. And do you have any thoughts or advice or expectations around how managers that you've partnered with think about when to sell a business or to try to sell a business or to sell a piece of a business. Really, I guess more on the portfolio management side of being a manager of a fund. Like, do you have any advice or recommendations on how these managers should be thinking about that if and when they have opportunities to sell pieces of a company?
Yeah.
Particularly if the ones that might be the most promising aren't immediately identifiable, as you think about that J curve.
Yeah. Well, one of the nice things about the venture business is that you basically have a 10-year lease on the money. And you don't have, there's not and there's really no risk of it being called out from you. So you have the ability to take a much longer perspective than a lot of other asset managers do, where they might, the duration of their money might be a lot shorter than they originally thought. But I think you have to weigh, you try to weigh the probabilities as best you can. I mean, I think if it's a company with, with a very open-ended market with a team that you really like, I would be inclined, generally speaking, to let the investment run and try to maximize the value of it. I mean, I guess that the exception to that might be if there was an investment that was so whose performance was so skewed relative to the rest of the portfolio that it was, that investment was really going to dominate the portfolio's return. And it would be prudent to take some money off the table, just so that if you ended up in a market, in a market environment where either it was hard to exit or it was only possible to exit at a valuation that really wasn't indicative of its long-term success, then you'd have a real skew in your performance based on that one investment. So I mean, an example, I think the contemporary example of that is kind of Benchmark with Uber, where Uber was such a huge part of that one fund that they had that I think they decided to take some money off the table early, or earlier than they might have otherwise, as a way of just managing the risk of that one investment.
How would you have reacted if you were in there?
How would I have reacted to that? I mean, I think in that case, I think that makes sense, just given how that one investment in it, and I wasn't in that fund. I haven't seen the numbers, but just, from things that I've read, but just given how dominant that investment it would have been, relative to all the other returns in the fund, that, and at that point, the fund was going to be a huge winner, kind of regardless of what else happened. So, locking in some of that gain and moving on, I don't think is anything that, a lot of people are really going to criticize.
Brian, I know we had promised 130 and we're at 142 here. So
okay.
You've been incredibly gracious with your time and insights, and we really, really appreciate this. And I can confidently say there are some nuggets of wisdom in here that I'm sure many managers will benefit from and be able to pull out here and use as they kind of do their day-to-day job. So thank you. We really appreciate it.
Happy to do it. And, I've really enjoyed working with you too, both as a limited partner and some of the other things that we've done. And I know my money is in very good hands with you guys. And, I think the primary thing that I'm focused on, particularly with an early stage fund, is what is the character of the people that I'm investing with, because as I said, you're basically, handing somebody control of your money for 10 years with, almost no ability to take it out. And, that's an extraordinary commitment. And I think to do that, you really have to have great trust and confidence in the people that you're working with. And, you guys are right at the top of the list. So it's been a lot of fun to work with you, and I appreciate all your hard work.
Thank you. And this is a great way to start off the week.
Absolutely.
Thank you, Brian. Really appreciate it.
Thanks, guys. Take care.
Take care.